So we have this thesis, the inflation is price gouging the economy, but the reality is what is actually causing the inflation? And we know it's always the money supply, and when it's being pumped up, the effects will be inflation. Well, that's actually starting to reverse. I built this indicator. It's a global inflation oscillator, and it's picking up the trend, right? What we're looking for is how to allocate a bond portfolio, and obviously when you're in the bottom, or I shouldn't say that, but let's say with this indicator, when it's deep in the green, obviously we've had an area where bonds did really well, and you actually would go inverse to this indicator, right? And then when it peaks, historically, it's a great time to buy bonds because they'll outperform. And we got the latest July numbers, and it's not suggesting outright deflation. It's just said that it's accelerating to the downside. So it's not exactly, but it's inflation, deflation direction. Now, what's also interesting is if you look at the update of the Bloomberg Commodity Index, that we can see its history here. And I love this chart because it calls turns where the public mood changes. And obviously in 2001, we had a massive run up in the commodity cycle because China enters the WTO. And at the peak 7 years later, the thesis was Malthusian panic, peak everything, peak oil. We're running out of resources, a whole bunch of theories to justify the massive asset bubble. And before it actually went into a secular decline and bottomed in 2020, and that it was oversold to the downside, which is the COVID-19 panic. And then we saw a nice rise into 2022, and it bottomed this year in May, and now we're having an uptick here for a couple months with the commodity cycle, and that's not good for the overall economy. So it just confirms with the leading indicators, the yield curve and so forth, that it's just going to put a further brake on the economy. Consumers can't afford higher prices, and that has to change. So if we look at global liquidity, this is from Richard Duncan's book, website. He's the one that coined creditism, this economic cycle since 71, since we've gone on this experimental fiat standard. And a perfect label, I love it, is actually creditism, not capitalism. This is what's causing a lot of the wealth inequality, asset bubbles, stagnant wages, and so forth. So you can see it's contracting. He's written 3 great books. This is one of them. The New Depression, the breakdown of the paper money economy. He also wrote Dollar Crisis and the Corruption of Capitalism. Excellent books. I highly recommend that if you're interested in that topic. Now, another thing is you look at real money. This is from Henderson Investors. And if you look at real money growth, China and Japan are not in negative territory, but the US and Europe is, UK. So that is a concern. And if we're going to get deflation next year, next year is highly likely. As I said, 2024, it's just the business cycle and how it's unwinding. Now, I'm going to just show you some interesting charts. Here's a bubble watch with Templeton. I learned and all from my masters. We're always looking. Where's the hot money? Where's the hot money running into? And we can see here, obviously, since 2020, it's the only bubble that hasn't burst. And it's a bubble. You can see in the last thesis that it collapsed 99% into 2007. So we've had a huge run up since 2020. It's rolling over the indicators. So we're watching what happens to that, to the downside. And this is, the 2 core aspects of the long wave, or TELTEM, the economic long wave, tactical asset allocation, is we're always looking at valuations and the age of the business cycle. These are what are risks. At the bottom of a business cycles, that's where the opportunities are. But most people don't do this. So anyways, the second interesting chart. Here is why the model is built as it is. Anybody knows the story, 1929 to 32, the markets dropped the same amount, about 89%. And the collapse, and that's simply, you can see the bubble before in the Japanese market erased all of the gains. It's all phantom wealth, and didn't bottom until 2009. And at this point, it still hasn't reached its top back in 1990. Now, if you avoid those losses, who cares what the market does after the fact? Because if you bought between 2009 2013, I mean, you've quadrupled your money here. So at least tripled. But the most important part is that's the same thing. It's like Joseph Kennedy, how he tripled his net worth during the Great Depression. He avoided the massacre, saw what was coming, the speculation, and when the markets tumbled, he bought assets dirt cheap. This is all we do here. That's what the model was designed. But we take two things into account. The business cycle, because it leads, the financial cycle, it leads, and then the stock market, and then the valuations. As Peter Kundo has alluded to many times, valuation is a measurement of risk, not timing. So bubbles, as we've seen, can go a lot higher than anyone expects. Now, here's what's coming in front of us. And you can see we have a vicious cycle of debt as the cost of this cycle then will cause a sovereign debt crisis and a currency crisis, because the governments have promised to support, or the government support the banks itself, but then the problem, it puts the government in a fiscal weak position, and then the refinancing of those costs, because of its vulnerability, interest rates rise, and then you get a cycle where there'll be a point that there is a break on the ability of the government to bail out the economy and the central banks. So there is a limit. There's always this belief that the governments can step in, but we're seeing now with Japan, there is a limit. And this is why historically, classical economics, you live within your means, and during the boom, you pay down the government debt, and during the downturn, you would spend. But governments are concerned about the short-term political cycle, and they will promise things without raising your taxes, so they go into debt or devalue the currency and create inflation, or raise taxes. When you're doing all three, you're just accelerating the insolvency of your currency, as is occurring in Canada. So that's in the future, and that'll be a video to speak about. This is interesting because the same occurrence is happening in Canada from Mish Talk website. And why it's fascinating is if you look at men's real wages since 79, they're actually lower than they were. I mean, during the disco era, think about your standard of living hasn't improved. But what Americans, as Canadians and Europeans, have done is they've gone into debt to make up the difference. And going into debt is just consuming from the future and assuming that you have a job in the future. So this is part of why this debt cycle is so important, because the wages aren't there. Unlike the heydays of the U.S. and Canada, real wages were rising, especially in Canada, since Confederation right up until the early 80s. Even during the Great Depression, real wages were going up. And that's why a lot of Canadians did very well during that time, which is unreported. And the same thing with a lot of Americans. But since this point, what have they done? And we've had stagnant real wages, and so Americans have gone into debt, and that was accelerated by the monetary wave, or as we call it, the down wave. But the monetary wave is very simple. It's the falling price of credit causes leverage, Ponzi finance, and unsustainable asset credit bubbles. That is it. It's very simple. Without the fall in interest rates, you couldn't have asset bubbles, and you haven't really seen, or any credit bubbles. because most of the times incomes and asset bubbles stayed within reason when interest rates are rising. And what we're seeing now is asset prices have to correct to the downside because of rise in interest rates. Anyways, so this is a interesting day in terms of information. As always, if you have any questions, comments, just post below. It's okay if you disagree with this. I'm using history, historical analysis, insight into the long waves, everything to come to a conclusion. As you can see, I'm not guessing. I'm looking at everything and presenting the data. And again, nobody's forcing you to accept this information. But for a lot of you, I know it makes sense, as it makes sense to me, exactly where we're going. All the indicators, what has worked in the past. Because none of this data starts in 1999. It goes back 500 years. And there is some good research that goes back even further. And it would be prudent to use as much information as possible to develop a model. So again, thanks for watching. Like, subscribe, let other people know who would be interested in understanding the long wave. Now, remember, particularly, I made this point on the Substack account is where you have access to the model, right? That will be solely focused on the markets. And so you might see this video there again if I'm just talking about the markets. But when I talk about technology, or the political cycle, unless it involves the markets, you won't see the post there. Okay. As always, thanks for watching, and we'll see you soon.